Welcome back to our listeners. You are here with Investing in Gold for a New Generation. My name is Rafael Kalamov and I'm here with Steve Skalls. Today's topic is going to be take advantage of volatility of gold instead of it taking advantages of you. So, for the subjects of today, first we're going to talk about gold over the past 2 weeks since we did our last podcast, gold's volatile nature, and typical and wrong buy and sell strategies versus the correct buy and sell strategies. We also want to emphasize to our listeners that our chats are for purely educational purposes. We do not encourage for any of you to take actions based on our discussions alone. You should do your own research and connect with a professional advisor. So, Steve, if you can just talk a little bit about gold over the past 2 weeks since we last did our podcast.
Yeah, so we've had a little bit of a correction. We're taping this on September 21st, 2020, and we're down $50 today. And I think this is a good day to talk about uh, gold's volatility. And as you stated, we're trying to take advantage of that volatility rather than have it take advantage of us. And yeah, the $50 down today. I mean, people want that simple explanation. Oh, there was some sort of announcement or political issue or whatever. And you know what, a lot of times for gold, the corrections are really just, hey, we had a huge run up in the price of gold in basically from late June to early August. We had a huge run up. We were up maybe $350. And a lot of what we're seeing now, this kind of correction, is just kind of taking out some of the people that got too excited by gold, got a little too leveraged in gold. And this is just par for the course. It seems like $50 down a day. Wow, that seems scary, but get used to it. It's, if you want to get the rewards of this market, you're going to have to accept the volatility. And hopefully in this video, we can talk about, really educate people about how to take advantage of that volatility. So no, I'm not going to try and give you one simple reason for, one external reason for why gold dropped. It's part of gold's natural ebb and flow during a bull market.
Yeah, perfect. So yeah, it is indeed a perfect day to speak about this subject because of the drop in gold that we saw today. So, historically, how volatile is gold? And for the future, what should investors expect? You already said it's volatile, but just how volatile?
Yeah, so that's really good. So today we're down $50, and that's 2.5% that we're down a single day. But if you go back and look at the last big gold bull market from about 2001 to 2011, gold was up about 700% in those 10 years. That's really good, just up 700%. And if you look at that, if you kind of pull up a chart or anyone looks at that, you'll see there was probably about 8 or 9 or maybe even 10% corrections. And those 10% corrections may have been in a matter of weeks, maybe a couple months. So a 10% correction is very normal. Okay, that's in a bull market. That doesn't mean the bull market's ended. It's just that's what you should expect. 10%, at least one 10% drop every year. But if you also look at that, you
If
see
I can,
maybe,
if I can just pause you for a second, I do want to, just say all the stats that, it would go up from 2% return in 2001 to 24% in 2002 to 21 in 2003 to only 5% in 2004. So you can see big changes there. And the next year from 5% to 17% in 2005. And then it went up in 2006 to 24%, went up again to 20 in 2007 to 32%, and then dropped all the way down to 3% return in 2008. And then it went up again, but just wanted to touch on some of the stats for those years.
that's really good because I was focusing a little bit on the downside volatility, but what you really highlighted is you also have years where it's up 20%, 25%, and then it has a year where it's kind of flat, and then it's up again 25%. So it gives you a really good sense of the volatility in gold. again, even in that time period, we had all those big up years, you had some moments where it was like, really scary moments, but we should just expect that. Now, there were, I think, maybe three really, really scary moments in that bull market. You had in 2006, gold shot up quite a bit in a matter of maybe 7 or 8 months, and then had a 25% crash in 6 weeks, a 6 week 25% crash. In 2008, we had a 35% crash. Now, that was also part of the financial crisis in 2008, but you can get even bigger crashes than 10% or 15%. So, and again, that was just pauses along the way of a 700% gain. So that's what we want to get. If you're looking at investing gold, you want to just say, okay, that's just par for the course. That's normal. I'm not going to get worried about that. I'm not going to I'm not going to see gold go up 25%. Oh, I missed the boat. I've got to jump in now and then get hit with a 10 or 20% correction. So that's just getting that mindset around gold. And I'll maybe just, share kind of how I see most gold investors operate is, they get fooled or taken advantage of by that volatility. For whatever reason in gold, it's like, hey, gold is up $300. Oh, I get it. I should own some gold. That's how they kind of think of it, when it's really, hey, are the seeds in place for a long-term gold bull market? I think they are. Maybe I'm wrong, but I think they are. And so to take advantage of that, I want to take advantage of those 10% drops, 20% drops. I want to be ready. That's when I want to be going in, rather than jumping in after it's gone up a lot.
Okay, so that kind of touches on when should investors buy and when should they sell, how should act when you see corrections in gold.
Yeah. So this is really important. Again, we're trying to flip that, how volatility is handled, rather than it affecting us, that we're taking advantage of it. So the way we can do that, given all those stats that you and I just quoted, so
Hmm.
we can look at the most recent run up in gold. We went from March to now, we went up from 1450 to 2075. So that's $625 in a matter of 5 months. So if we just step back and
Crazy.
say, yeah, crazy. And I could definitely see a lot of people getting super excited. Like, I was getting emails from people back in August, almost near the top, saying, oh, I wish I'd bought more gold, or I'm going to buy. I can't hold off any longer. And it's like, okay, hold on, hold on. We should expect, after a big run up like that, we should expect at least a 10% correction. So 10% would be about $200. And what happened? In about 3 days, we had a $200 correction. Okay, so that was like, okay, that's your first point where you can say, okay, that's probably a good time to start thinking about buying. Not after the big run up, but after you get that 10% correction. Now, that 10% correction can turn into a 20 or 25% correction. So what I suggest to most people is, let's say you want to put 10% of your portfolio in gold, whatever percent you've decided, I want to put 10% in. Let's say that's $50,000. What I would suggest is you say, okay, divide that into 4 pieces, about 25% each, and say, I want to put that 25% of that 50,000 in maybe every 3 months. Every 3 months, I'm going to buy another 25% till I get my total allotment of $50,000 invested. And what you can do is say, okay, I'm going to start on that correction, that 10% correction, and then I'm going to just buy every 3 months. Or if there is a 20% correction or 25% correction, then I'm going to get more aggressive. I'm going to buy 50%, or maybe 75% if it's even a bigger correction, so that you're kind of diversifying across time. So you're not getting too excited by what's happening now, but you're also, if you do get that big correction, like super big correction, 25%, you're taking full advantage of that, that you're ready, that, hey, 25%, that's about as good as you're going to get. Maybe that's not going to be the perfect bottom, but that's a pretty solid correction. Take advantage of it. That's how I would advise people to manage that purchase. Divide it into four spots, for purchases over time, but then take advantage of that really big correction. So a 25% correction, 20% would be $400, 25% would be 500. So that would be down to somewhere in the 1600s or 1500s. That's what I would look at as a really big opportunity. If we got it, might not get it, but that's what I would be looking for to really get super aggressive at buying.
I think I want to add on to this by saying that in order to follow these kinds of rules that Steve sets out, you have to be very confident about the investment of gold. Because sometimes most investors, and I think a lot of investors, what they do is they invest when things go up and get really scared when things go down. And they don't invest, in fact, when things go down. So for example, if we do see a 25% correction, investors who are not invested in gold or are not that confident in investing in gold, they see gold prices dropping down and you're saying something to yourself like, no, this is the worst investment. It just dropped by 25%. And and then you end up investing when maybe you see that gold prices go up really high. You say, this is a great opportunity. Gold prices are going up. I'm going to make money if I invest.
Right.
What you end up doing is you end up setting yourself up on the wrong side of the buy and sell every single time. You're going to end up buying when it shoots up, when it's most expensive, and sell or lose the opportunity of buying when it's all the way at the bottom, which is a great opportunity of buying, and then waiting for it to go up.
Yeah, that's a perfect explanation. People, I would say, get fooled by the market. It's like, oh, it's going up. This is a great investment. Oh, it's going down. It's a horrible investment. And that's where we were in March of this year in 2020, where I was expecting, okay, I want that 10, 15, 20% drop. We had a $250 drop in gold. And all of a sudden, lots of people I talked to were like, oh, this is a horrible investment. The stocks are crashing, gold's crashing. It's a horrible investment. They just weren't mentally prepared to take advantage of that. And now what have we had? We've had a 40% increase since then. And now people are interested in it. So it is, and I think the first thing that you said was really important was you need to make sure you have a clear idea as to what, is this fundamentally a good investment, such that I want to take advantage of lower prices rather than trying to chase it after it's gone up. So that is an important thing, and that's what we want our listeners to get their head around in our podcast is, is there room for this in your portfolio? Is this the right time to put in your portfolio? Once you made that decision, then thinking about how you execute that in real time and be in a position where you can take advantage of the corrections when they come.
Cool. Um, Agreed. So I have a question. What makes gold prices volatile? What are things that make that price go up and down aside from, I think, a huge influence is investments. I feel like the reason we see a crash, I almost feel like investors like you and we wait for a crash. And then when there's a crash, or where there's a correction, I should say, we invest. And all of that investments and other investors act this way, make that price go up again. So that, I think that's one aspect of volatility. What are other aspects that make gold volatile? For example, maybe it's supply and demand, what mining companies out there are doing, stuff like that, politics.
Yeah, and I think there's at least two levels to look at that question. So there's the broader picture that we kind of touched on in our September, I think it was September 4th podcast, where we talked about just the general seeds of a long-term bull market, how mining companies are, cut back production, cut back exploration, things like that, such that you have supply declining, but you have demand starting to increase because people are looking for an alternative to stocks and bonds. And so you're having these forces kind of, demand going up, supply going down. And that's, kind of the tectonic plates that are moving that are creating this, mountainous bull market. So those are the bigger forces at play. The day-to-day or week-to-week forces are when you've got speculators or traders. This podcast is really for people that are looking for a medium term or long term investment. But when you've got speculators that see the price going up and they start chasing it, or it's kind of like Cinderella at the ball. They want to stay in right until just before midnight and get out before the crash happens. So you've got a lot of traders and speculators jumping in and out. And then if you look at how much leverage, if you look at the commodity futures market, where, I was looking today, a gold investor could have 20-to-1 leverage. So they could put up, $10,000 and they could control $200,000 of gold. And so small movements in the price of gold can create huge returns or wipe them out really quickly. So it's really the ebb and flow of those speculators getting, too excited as it's going up and getting, forced to sell when it's going down and they have to sell at any price. That creates that kind of shorter term volatility. That's the 5%, 10% corrections, the $50 corrections. Sometimes that turns into a bigger correction. Here and there that happens, but most of that kind of day-to-day volatility is the influx of speculators or forced selling by speculators, as opposed to the bigger picture of supply and demand really pushing this longer term bull market. And I think that's important because people, when they see these kinds of sudden drops, they want one reason. One reason like, oh, the Federal Reserve made this announcement, or the U.S. presidential election is coming up and there was some speech. Sometimes that definitely has some impact, but it's often dwarfed by the ebb and flow of just speculators trying to chase prices or get out before the price declines. So that's often when I see these price declines, I look to the news, but I don't put too much weight on that. I'm because I've been around this market a long time. I just expect this kind of volatility and hope to be in the right mindset to take advantage of it when it happens.
Exactly. And so I think that speaks out to a lot of people who are interested in gold. What you got to be doing is you got to be thinking long term, 5 to 10 years, maybe a little shorter, it depends on what you're interested in. But this daily news and the daily volatility you see on the stock market, on the gold market, don't worry about it too much. It's going to go up, it's going to go down. You're going to have some losses, you're going to have some gains. But what you're shooting long term, so keep thinking long term.
Right.
Don't get too frightened. Don't get too irrational when interested in investing. Set some rules, set some guidance for investments for yourselves. For example, at a set amount of dollar price, I'm going to invest. At a set amount of uh, drop, I'm going to invest in gold. Or in a set amount of gain, I'm going to sell. Set some rules, keep to those rules, and stay rational. Don't worry about the everyday volatility. It's going to happen no matter what.
Right. Exactly. Yeah.
Perfect. So I think we covered everything, Steve. Do you
Well,
think is there anything else you wanted to
well,
talk?
one thing. So we talked about when to buy,
Yeah.
but another decision you'll have to make is when to sell.
Now,
And
are you talking frequently or are you talking long-term selling?
well, and that's a good distinction because we want to make that distinction that, as you said, this is a longer term investment. So selling, it's not necessarily something we need to get into a lot right now. We're kind of saying, hey, let's look for some opportunities to take advantage of this bull market to buy for the medium and long term. But at some point you will need to sell. And there's some different strategies, and this is something that we can get into in a later podcast. But one thing that I think is very interesting is some sort of what I'll say called asymmetric rebalancing, where often an investment portfolio will say, okay, I'm 30% bonds, 55% stocks, 15% gold, and people will every year they'll rebalance to those percentages. So if something's up a little bit, they sell it off to get back to their baseline allocation. If something's down a little bit, they'll buy a little bit more to get back to those allocations. But I think with gold, because it has these, corrections, but it can have these long, big move bull markets, you want to be a little bit slow to rebalance. So maybe rather than always going back to that 10% allocation or 15% allocation, you might say, hey, I'm going to, here's my allocation and it's grown to here. Okay, I'm not going to sell all the way back here every year. I'm just going to sell a little bit. And if it goes up again, sell a little bit more. And that way, you're still allowing yourself to capture a big run of that bull market. It's something that we should get into more into a later podcast, but I think for now you want to be a little bit slower to sell is kind of my main point. And I would say big picture, long term, when you think you are the greatest investing genius of all time, sell at least half. Sell at least half. That is
Write that down.
Yeah, write it down. When you think, oh, I knew this was going to happen. I'm so smart. Sell about half. Okay, so we might have a few moments like that in the next 5 to 10 years, and that's kind of a signal. Investment markets, just like they can, fool people with the volatility. When you're thinking you're the smartest person ever, it's probably just you've had some good luck, you've had a good run, take a number of chips off the table. So write that down. That's our long term. When we're sitting here talking like, oh yeah, we're the smartest people ever, that's when people should turn off the podcast and sell half their gold.
Perfect. Well said. Okay, I think that's everything for today. For next time, we're going to talk about gold versus gold mining stocks and their important distinctions, their advantages and their disadvantages. Thank you, Steve.
Yeah.
Bye-bye.